Just 48 hours ago, the crypto world was staring into the abyss. Bitcoin didn't just dip, it suffered one of its worst single-day declines in a decade, crashing through the critical $70,000 floor and bottoming out at just over $60,000. The panic was real. Institutional sentiment, tracked by the Coinbase premium, had turned deeply negative. For 21 straight days leading into this, American institutions were selling while the rest of the world tried to catch the falling knife. The store of value narrative was under fire as Bitcoin hit its lowest level since October 2024. So, what triggered the carnage? Analysts call it the Warsh Shock. The nomination of Kevin Warsh to the Federal Reserve sent shockwaves through the markets. As a longtime critic of the Fed's massive balance sheet, the prospect of his leadership signaled a tighter for longer monetary regime. Less liquidity means less fuel for speculative assets. Traders, fearing a restrictive Fed, aggressively de-risked. By Thursday night, Bitcoin had wiped out all its gains since the 2024 election, leaving over-leveraged ETF holders underwater with an average acquisition price of $90,000. Then, the miracle happened. On Friday, February 6, 2026, the broader financial markets staged a historic comeback. The Dow Jones Industrial Average surged over 1,200 points, crossing the 50,000 milestone for the first time in history. This wasn't just a stock rally, it was an AI-driven explosion. With Nvidia jumping 8% and tech giants doubling down on hardware spending, the risk-on appetite returned with a vengeance. As the S&P 500 edged back into the green for 2026, the capital overflow trickled directly into the most beaten-down asset, Bitcoin. As the Dow hit 50K, Bitcoin didn't just bounce, it ignited. The sudden 15% recovery back to $70,000 in a single day was fueled by the mother of all short squeezes. Bears who had bet on a further drop to $50,000 were caught in a trapdoor scenario. In just 24 hours, $2.6 billion in short positions were liquidated. This forced buying created a feedback loop, propelling BTC past $71,000 and sending shares of crypto-linked firms like Strategy up a staggering 25%. Is the bottom finally in? While the V recovery was legendary, institutional analysts from 10x Research and Fundstrat remain cautious. The market is currently stuck in a tug-of-war between high-conviction buyers like Michael Saylor, who added another $75 million during the dip, and a Fed that is still transitioning leadership. For now, the $60,000 level has proven to be the line in the sand. Bitcoin is alive, the Dow is at 50,000, and the digital gold rush has found its footing once again. Despite the explosive 15% recovery, the market remains on a knife edge, and seasoned investors are urging extreme caution. While the bounce back to $70,000 provided much-needed relief, many analysts, including those from Galaxy and CryptoQuant, warned that this could be a dead cat bounce or a mechanical relief rally rather than a true trend reversal. The concern lies in the supply gap between $70,000 and $80,000, where a lack of established ownership could lead to further instability. Large-scale, whales, and institutional players are currently monitoring the market's depth to see if there is genuine retail demand or if this was simply a temporary squeeze on short sellers. With on-chain data showing a significant number of holders still at a loss and the Warsh Shock potentially signaling a tighter economic environment ahead, big investors are waiting to see if more traders are actually willing to sustain these levels or if the market will drift back to test the $60,000 floor once again.